Welcome back. Let's stick with our focus on inflation and rates, this time with a focused discussion on the U.S. Fed. Again, the U.S. Fed meeting begins today. The announcement is due tomorrow. The consensus call, I believe, Allan Small, is for a rate hike of a quarter of a percentage point. But so much has changed since the last time the Fed made an announcement. And what has changed is the failure of Silicon Valley Bank, the crisis at First Republic, the failure of Signature Bank in the United States, higher rates, a material influence on those banking crises.
Yeah, definitely a different picture, but it looks like a quarter point is where they're going to land. The Fed, the terminal rate still, I believe, is well over 5% in the U.S. So a lot of people thinking that they're going to continue to raise, albeit a lot slower. Some are saying, like Goldman Sachs, that they won't raise at all, and others are thinking they'll raise a quarter point. I think they're going to maintain that quarter point. I think a couple of weeks ago they were talking maybe even 50 basis points. But I think with the recent bank crises in the U.S., they're going to scale it back to a quarter. And, I've said all along, in my opinion, that I think the Fed should be held responsible for a lot of what's happened to these community banks, SVB, et cetera, Signature Bank, pushing the envelope as they have over the last year. You're bound to see cracks in the armor. And I know a lot of people have said, well, they gave ample notice. They've told everybody what they're going to do well in advance. So that kind of gets them off the hook. Well, it's kind of like, telling the bank, well, we're about to rob you, but because we told you in advance, we're not responsible. So to me, I just don't buy that. I think that, it shouldn't be this whole message of we're just going to push until something cracks. Overall, I think inflation has come down pretty much everywhere in our country, in the United States. And I think a pause definitely would make sense. I think this meeting might be difficult to pause, but perhaps the next meeting, a pause would make sense. So hopefully the Fed will stop pushing the envelope here, and we'll start to see a little bit more calmness and maybe see that dollar start to pull back a bit and maybe see our dollars start to increase.
And you've got to think, when economic history of this era is written, the view of central banks that central banks plural, not just the Fed, but others as well, that inflation was transitory. The inflation we saw was transitory. That's not going to look very good in the sweep of history.
Not at all. They were late to increase, and then they felt like they had to play catch up, which obviously caused different issues, bigger issues perhaps. And here we sit, obviously a lot higher Fed funds rate, a lot higher here in our country. Interest rates are higher, although again, because of the crisis, a lot of these rates have pulled back. You're looking at the 10-year now in the U.S., 3.5% when it was over 4%. The 2-year, it used to be as high as 5%, well below that level now. So I think the market's anticipating a pause in the not so distant future, and even maybe some rate decreases towards the end of this year. So we'll have to see what happens.
What is the takeaway for investors? Rates have been so influential in the path of the markets, obviously, for more than a year and a half now.
Well, I think you can look at some of these interest rate sensitive sectors. Technology, for example, it was the number one, sector that was hit the most last year. Interest rates rising, technology stocks pulling back. I think now that we're closer to the end of the rate hiking cycle, you can now start to look at some of these big cap tech names. And I think a lot of investors already have, especially to start 2023.
So you think the tech rally, which is a feature of the markets thus far in 2023, has legs?
I definitely do. I think it has legs based on lower interest rates. I think the Fed getting closer to the end of the rate hiking cycle, as well as obviously new technology like artificial intelligence and things like that. I think this will continue to drive a lot of the big cap tech names.
Which names do you like in tech?
Well, I like Amazon. I like Google. I think these names have pulled back significantly from their all-time highs, 52-week highs. I like some of the chip names. I think NVIDIA, which is their chips driving the AI cycle, AMD. A lot of the names that we've seen a bounce back already, but some of them still have not. And a name like Meta as well, with their cost-cutting measures, I think their name can still go higher, even though it's more than doubled off the lows.
Do you have a call on broad market indices, the S&P 500? Will it respond positively if you are correct about where the Fed is going?
I think it will. Obviously, banking is a factor that's been weighing on the S&P. If we can get some clarity and get some more confidence in the banking sector, I think the S&P will rally. But also, don't forget, technology makes up the largest component. And as interest rates are lower, a lot lower right now. Tech has been leading the way.
What about the scenario of Fed rate cuts later this year? That was the optimistic scenario, the bull scenario at the beginning of this year. It quickly got swept off the table as inflation seemed more persistent than expected. Now the banking crisis emerges, and once again, this idea of rate cuts late in 2023 seems to be back in play.
Yeah, and I think the market is being maybe a little bit optimistic with regards to that. I still believe that rate cuts may happen, but I think it's going to be pushed out even further. The banking crisis, I believe, will kind of sort itself out over the coming weeks, and I think that rate cut scenario, again, probably won't happen for a little ways yet.
Okay.